Imagine waking up one day and realizing your portfolio has reached the seven-figure mark. Sounds impossible, right? Well, what if I told you it's not? I started with just $10,000 and turned it into over $1 million. With the right strategy and consistent investing, you can do this too. Let me walk you through the exact steps that helped me achieve this success. 1. Start with a simple, clear strategy. The first thing I did when building my seven-figure portfolio was choose a simple but effective strategy. Simplicity beats complexity every time. I decided against picking individual stocks and complicated investment schemes, knowing that this approach would be the most straightforward and efficient. Instead, I focused on three core ETFs, low-cost, diversified funds that offered both long-term growth and exposure to a wide array of stocks across various markets. By choosing three low-cost ETFs, I could easily cover global markets without having to manage a bunch of individual stocks. The key here is consistency and a long-term view. I didn't need to worry about chasing the latest stock trend or reacting to every piece of market news. I could focus on building wealth steadily, not reacting to every market move. This was a smart, intentional approach that set the foundation for everything that followed. In the next step, I'll show you exactly how I selected the ETFs that formed the backbone of my portfolio and how you can apply the same strategy to start building your own wealth. 2. Choose low-cost, diversified ETFs. Once I had a strategy in mind, I needed the right tools. I wanted to invest in a diversified portfolio with low fees, so I chose three core ETFs that would give me broad exposure to various global markets. This would ensure my portfolio was well balanced, offering long-term growth across different regions and sectors. The first ETF I chose was XEQT, which forms 80% of my portfolio. XEQT is a globally diversified equity ETF, meaning it covers Canadian, US, and international markets, giving me exposure to thousands of companies around the world. This was my core holding, and it allowed me to gain exposure to global stock markets with a single investment, providing the diversification I needed from the start. Next, I allocated 12% of my portfolio to VTI, which covers the entire US stock market. I wanted to make sure I was tapped into the US economy, which has a long track record of strong growth. This ETF allowed me to gain access to some of the world's biggest companies like Apple, Amazon, and Microsoft, companies that have historically been key drivers of global economic growth. Lastly, I invested 8% of my portfolio in VT, which tracks the performance of the entire global stock market, including emerging markets. This ETF gave me exposure to areas like Asia and Europe, where there are significant growth opportunities. Having exposure to these markets ensured that my portfolio wasn't overly reliant on any one economy, providing valuable diversification for my long-term financial goals. By focusing on these three low-fee, diversified ETFs, I set myself up for growth without worrying about the complexities of stock picking or reacting to short-term market swings. 3. Commit to monthly contributions. The real power of building wealth doesn't come from a one-time investment. It comes from consistent contributions. After selecting my ETFs, I made the decision to invest $2,500 per month into my portfolio. Even though I started with only $10,000, the monthly contributions made a huge difference over time, and I quickly saw the impact of this steady approach. By contributing consistently, I was able to take advantage of dollar-cost averaging, meaning I bought more shares when prices were low and fewer shares when prices were high. Over time, this strategy helped smooth out market volatility and increase the number of shares I owned, which led to compounding growth. This wasn't about trying to time the market. It was about building wealth over the long haul. For example, even when the market was down, I kept investing. In fact, market downturns were the perfect opportunity to buy at a lower price, adding more shares when the market was undervalued. This consistency built momentum, and before I knew it, my portfolio was growing steadily month after month. Consistent investing doesn't rely on market timing. It relies on your ability to stay disciplined and trust the process. 4. Reinvest dividends to maximize growth. One of the most powerful tools in growing a portfolio is reinvesting dividends. Every quarter, my ETFs paid out dividends. But instead of taking those dividends as cash, I reinvested them back into my ETFs. This simple decision turbocharged my portfolio's growth by leveraging the power of compounding. For example, when I earned $10,000 in dividends, I didn't spend it. I used it to buy more shares of XEQT, VTI, and VT. By doing this consistently, I allowed my money to work harder and grow faster. This is where the snowball effect of compounding kicks in. The more shares you own, the more dividends you earn, which you can reinvest to buy more shares. This is how wealth truly builds over time. Over time, reinvesting dividends allowed me to accumulate more shares and significantly increase my portfolio's value. The key to fast growth is letting your dividends work for you instead of withdrawing them. If I had cashed out my dividends, my growth would have been slower, so this step was crucial for accelerating the process. 5. Stay consistent and avoid timing the market. Here's a key lesson I learned. Timing the market doesn't work. I stayed focused on my long-term goal and didn't get distracted by short-term market movements. The market was up and down, but I didn't panic. Instead of trying to time the market or react to market dips, I stayed consistent with my monthly contributions and trusted that over time, the market would reward my patience. Staying consistent meant I didn't have to worry about trying to buy and sell at the perfect time. I simply continued investing, no matter what was happening with the market. When the market went down, I bought more shares at lower prices, which allowed me to take advantage of those dips. This approach helped me build my portfolio without stress or second guessing. The key here was focusing on my long-term strategy and not getting caught up in the emotional ups and downs of the market. Staying the course and trusting the process is how you weather market volatility and ensure growth. 6. Rebalance annually to stay on track. As my portfolio grew, I noticed some of my ETFs were growing faster than others. For example, XEQT might have grown to make up 85% of my portfolio instead of the original 80%. So, to make sure my portfolio stayed balanced, I decided to rebalance annually. Rebalancing is simple. I sold a portion of the ETF that had grown too large, like XEQT, and used the proceeds to buy more of the other ETFs, VTI and VT, to restore my original allocation, 80/12/8. This helped maintain a diversified portfolio and ensured I didn't become too exposed to any one sector or market. Rebalancing is important because it ensures your portfolio doesn't become overexposed to any one sector or region. It also helps you maintain your original risk profile, which is crucial as your portfolio grows. By doing this annually, I stayed aligned with my long-term goals and made sure I wasn't exposed to unnecessary risks. 7. Minimize fees and taxes for maximum growth. One of the most important decisions I made was minimizing fees and taxes. I chose ETFs with ultra-low expense ratios like VTI 0.03% and VT 0.06%, which meant I wasn't paying high fees that would eat into my profits. Low fees meant more of my money was working for me, rather than going toward administrative costs. Additionally, I took advantage of tax-efficient accounts like the TFSA and RRSP. By investing in these accounts, I was able to minimize taxes on dividends and capital gains. This allowed my money to grow tax-free or tax-deferred, giving me an extra boost in reaching my seven-figure goal. Keeping fees and taxes low is crucial to maximizing growth over the long term. Building a seven-figure portfolio doesn't require insider knowledge or a massive initial investment. It's about making smart, consistent decisions over time. By sticking to a simple strategy of low-cost ETFs, regular contributions, reinvesting dividends, and minimizing fees and taxes, I turned my initial $10,000 into a seven-figure portfolio. And if I can do it, so can you. With patience, discipline, and the right approach, you can build your own wealth, no matter how much you start with. If you're ready to start building your own seven-figure portfolio, hit that like button, subscribe, and drop a comment below. Let's start building wealth together, one step at a time.